Is that
Right.
expiration, what you put in already?
For your body.
Expire, so that is your termination. But you're both agreeing to expire, but instead of 9:30, you want to push it out till 10:01 or 10:02, whatever you want, we can send it over.
Thanks for noticing this time.
All right, well,
It's a great sign, they're unique, I like them. Thank you.
All right. So who's been in this class before? All right, so it's exciting, fun. Topics are great,
You look back.
all right? That's just because you still are missing things, right? So the agenda, I never really have any. Basically, I am still a practicing CPA, I have a master's degree in taxation. I take 80 hours, I take 40 hours a year, 80 hours every 2 years, and the majority of that is in tax law and tax practicing. So today, I don't know what your expectations are, and you can tell me if it's gonna be fulfilled by this. I basically break this out into 2 parts. The first part is just talking about taxes overall at a high level. When should and for real estate brokers, so this is tailored for real estate. And I'll talk about, entities and what makes sense. And I'm all about being practical, not making changes until you need to make changes from an economic standpoint. So for the majority of you, who's less than a year in the business? Who's less than 4 years? How long have you been in the business?
Oh, I just don't.
Okay, so less than a year. So for most of you that are less than a year or less than a couple of years, if you're not making 100 grand, you're most likely just gonna be a sole proprietor. It's not gonna make sense for you to go into another entity at this point. And when I say 100 grand, like if I were to ask most people, what you'd like to make this year, almost everybody goes, well, you know, the newer in the business, I want to make 100,000. Well, once you start breaking down your expenses, you're not really making 100,000, right? After expenses, you're netting a smaller amount. And so because it's a smaller amount, by the time you factor in the work, and I'm gonna go through all this with you, the work associated with having an entity to run your business income and expenses through, it's not worth it. You're not really saving any money. You're making money for an accountant or a CPA, but you're not really saving any substantial amount. Now, the break-even point for who has an entity that they run things through? Okay. For the most part, and you handle your own taxes, or do you pay somebody? Okay, so let me just ask you a real world question. How much fees are you paying between an accountant and maybe a bookkeeper? Do you have a bookkeeper? Okay, so you handle your own books? Okay, so are you doing payroll service? Okay, so are you doing a W-2? Yeah. Okay, so how much are you paying for your personal and corporate or LLC return? Ballpark, to get it prepared. And do you have any review sessions with your accountant ahead of time?
Yeah.
So how much do you think you spend overall in a year for preparation and advice?
I think like $2,000.
So undercharging. Hey, I'm like 1,000, and I'm not listening to fun. So that's why I'm bringing this up is you would hate to be spending, you know, a couple $1,000s on somebody and possibly a payroll service too, if you don't know how to do W-2s, W-3s, 941s, 940s, state unemployment forms, correctly. It's not worth the headache and the risk. And so your break-even point for when you want to transition over may come down to more legality. Was that more of the reason that you established to create a veil of protection? So there's really 2 reasons to set up a company to run your business through. One is if you have a lot of personal assets or investments, you want to keep that business separate from those other assets. 2 would be tax savings. And let me be clear, it's tax savings, not tax avoidance. Tax avoidance is against the law, and you can go to jail. So everything I talk about is about minimizing your taxes. That's all. Then the second part we'll talk about is what can you write off? how can you write it off? Why can you write it off? What are the rules for the different write-offs? And I'm not gonna get into, office supplies and postage, but we are gonna talk about vehicles, home offices, gifts. We're gonna get into the stuff that's a little bit more creative. That if you do it right, gives you a great tax deduction. And if you don't do it right, you could pay the price to get audited. Hey, for those of you that are on Zoom, I apologize. I left the house this morning without my laptop adapter. And so my laptop is dead from a masterminds this morning. So you can hear me, but you can't see. Oh, I guess you do get the back of my head, don't you? A nice bald spot. So if you have any questions, just speak up. So playground rules. In my classes, if you have to make a phone call, take a phone call, text, whatever, and just step out. That's fine. If you go to the restroom, that's fine. This class, I think, is an hour and a half. We'll probably go an hour and a half. I won't take breaks. If you've ever been in any of my classes, I rarely take a break. We just hammer on through. And then if you have a question, I'd rather you stop me and ask the question, than to wait for me to create a break, because it's not gonna happen. Just FYI. All right, so let's start with entities. When you got into real estate, you got into a self-employed profession. You're not an employee of this office. You are an independent contractor. You signed an independent contractor agreement. As part of that, we don't set your hours. The office doesn't set your hours. It doesn't tell you what to do, when to do it. You don't punch in, you don't punch out on a time clock. You either make some money or you don't make some money. It's entirely up to you how you run your business in the end. I will encourage you, for those of you that are newer in the business, get control of your business hours early in your profession and decide if you're gonna be that broker that's available at 10 p.m. or if you're the broker that shuts it off at 7 or whatever time you shut it off at. I've never yet had a real estate emergency at 10 o'clock that couldn't be handled the next day in the end. It's probably too late. Thank God they finally added a time of day deadline. So we don't have to be worrying about monitoring for an inspection objection to come through at 11:59 at night. So as a sole proprietor, there are pros and cons, and so I'm going to give you the pros and cons of sole proprietor, and then what are the other entities that you could utilize when and if you're ready to. And I said break even point when it makes sense. I'll give you some examples. We'll kind of run through some real world numbers. I will tell you, I've had people, after I explained some of the complexities that go along with entities, that I had one that was like, Kevin, I could make $250,000. And I'm not going to go into an entity. It's just too much brain damage, too much work. That's something each of you have to make your own individual decisions. For me, that is my superpower is numbers and complexity. If you've ever sat in any of my classes, that's one of my few gifts. I can't dance, I can't sing, any of that stuff, but I can work numbers. I work numbers really well. So when you think, as I go through the complexity of this, I'll just put it in perspective. I have 1, 2, 3, 4 LLC partnerships. I have 1 sub S corporation. I have 1 C corporation, and I'm missing one. And I'm trying to think of which one I'm missing. So I have to do tax returns every year. I usually do mine in December, January, so I can get mine knocked out ahead of time before I even get to my personal tax returns. And those all have cash flows that will then come down into my personal. Well, actually, that's not true. 3 of the LLCs go into a holding company, which is the sub S, and then dividends and cash flow comes down to me personally. So it's a very, very, very complex tax strategy. And I have to be sure that I'm dotting my I's and crossing my T's, because you make a mistake that can have a cascading effect on all my businesses at that point. I have them set up that way for a number of reasons. One is passive cash flow. It is not W-2 income, so it's not taxed with Social Security, Medicare tax. And 2, from a legal standpoint, I protect each of my businesses from the other businesses, and I protect my investment properties from the businesses and vice versa. So if I do get a bad tenant, like here, if my business was to become a bad tenant in the building, I can separate that. It's a whole different issue, and I'm not subjecting all of my, business interests to cascading lawsuits. Does that make sense? Okay. All right, so let's start out with sole proprietor, pros and cons. As a sole proprietor, which 6 of you, I think only 2 of you raised your hand as an entity, 6 of you, Debbie, are you an entity? Okay, and so that goes to show you, you know, I know of another one too that's, does really well in the office that's, is a, Schedule C, sole proprietor. And a lot of times it is because it's something, that's how they've been doing business for a very long time. I will tell you that the tax law right now specifically is very advantageous for Schedule C. With the, what's called the QBID, which is the Qualified Business Income Deduction. However, that does sunset, I believe, in 2029 or maybe 2027, and that's the tax law that was passed back when Trump was in office. I've got mixed feelings about it, honestly. On a personal note, I would like it to sunset, because one of the worst tax laws that they put into place was called the SALT, which is state and local taxes of a limitation of $10,000. And that is a freaking killer for me personally, and for a lot of other individuals. When we do have high real estate taxes and high state taxes, to not be able to deduct more. I'm probably losing 20 grand in tax deduction because of that limitation. So I'd like to see that go away. However, I love the QBID. That was extremely helpful for all of us. And by the way, NAR did that for you. So I want you to understand, NAR, which is the National Association of Realtors, dues are coming up. I am a huge proponent of what they provide to us, and that was one of the things they lobbied for. We were the only, well, there's 2. We were one of only 2 service-oriented industries that got a qualified business income deduction with the tax law change. The other happened to be architects. Don't ask me why, I don't know. Even attorneys did not get the QBID. So if you weren't in a industry that has a product, and I believe our industry does have a product, it's just not, we don't own the product, you don't get that QBID deduction. That was huge. That's just one of the things that NAR does for us on a regular basis, and without somebody lobbying in Washington DC, the impact that it could have when they undo a lot of the things that are in place, like 1031 exchange, $500,000 married filing joint capital gains deduction if you've lived in your home for 2 out of 5 years or 24 months out of 60 months. What impact do you think that would have on some of our clients who are selling if all of a sudden they have 700,000 in equity, and instead of only paying capital gain on 200, they're paying on 700? What if you lost the 1031 exchange? And now you've got investors who have $1 million in equity in their entity because they've depreciated the asset completely. Are they gonna sell that asset now? Or are they just gonna hold on to it till death? Because then they can get the stepped up basis for the air. Oh, what if that goes away? What if the Washington decides we don't deserve a stepped up basis because we want the tax money on all of this? What impact is that gonna have on our real estate business? Huge, absolutely massive. All right, I'm off my soapbox now. So as a sole proprietor, pros and cons. Pro, it's really easy. It's really simple. Like, you can do the shoebox grocery bag thing. You can throw all your receipts all year long into your bag and deal with it, you know, on a weekend in December, January, to do your taxes and figure out what your different expense categories are and how much expenses you have in each one. It is simple. It is I have a lot of pros. You can commingle your funds, so you don't have to keep track. You don't have to have a separate business account that you're tracking your money. Now, I will make a suggestion for you. Debbie, your biggest year that you ever had with commissions, did you know in January that it was gonna be that kind of year? Did you know in February? Did you know in March? Did you know in April, May, June? When did you finally figure out this is gonna be one hell of a year?
The end of the year.
Yeah, and so if you're not doing things proactively ahead of time, you might find yourself that you're a sole proprietor and you wish you had become an entity. Well, here's the deal, you could. but only if you held yourself out appropriately, meaning I really highly recommend that you open up a second account. It can still be in your personal name and treat that as your business account. Loan it some money, so it covers expenses until you have income coming in, and then take a draw, take money out for wages, for, compensation. That way, so the IRS does, the IRC, which is the Internal Revenue Code, does allow for setting up an entity in the past, as long as you've been treating it like it was an entity. So meaning it allows you to set up an entity. I set up one February of the following year for the beginning of the previous year. So it allows for that. However, did you hold it out in character? If you commingled your funds and you didn't keep track of stuff and you can't you can't do a set of books off of that account, then you'd have a problem if you got audited. But if you do have a separate account, you treated it appropriately, then we can work with that, right? And the IRS will work with that, and they'll allow for you to set that entity up and recognize that entity at a later date. So I would encourage you to get a separate business account, not a business, you don't have to set up as a business account because you don't have a business name. Set up a separate account, loan it some money, pay your loan back when you make money, write your expenses off from there, and once you are generating money, take a draw out of there for income to you, and then put that in your personal account. That way, if you do have that year, and I've had every year, there's somebody in one of my offices that's like, I had that year. Did you do what I said? And I didn't set up a separate account. Then you're gonna have to file as a Schedule C, and you're not gonna be able to receive the tax benefits that I'm gonna talk about with entities. Okay, so if you just prepare ahead of time, and here's the deal, let's say you don't have that year, that's okay. If nothing else, you've organized yourself to think of this as a profession, as a, not a career, as a business. Does that make sense? All right. So, no, you're late, it doesn't, no.
Yeah.
And so, as a sole proprietor, it's simple, it's easy, you don't have to fill a lot of forms out, you can commingle your funds. By the way, I've never ever dealt with anybody with a grocery bag of receipts, I've had people try. And I'm like, so I charge $400 an hour, is this really what you want me to do for you? Which I'm still not gonna do at $400 an hour. So I'm not a big fan of that, but I know many people, many successful people, that's how they run their business. I personally keep track of my income and expenses on a monthly basis. So I know exactly where my businesses are, religiously. Cons for a sole proprietor. You cannot write off employee benefits. You can write off health insurance, but you can't write off expenses, out-of-pocket expenses for health. You can't write off a retirement plan pre-tax so that you avoid FICA and Social Security tax. You cannot, you are in the highest audit risk for a business. And the reason I say it, okay, so when I say the highest, that's still like single-digit percentage. Okay, it's a very, very small amount. As a matter of fact, believe it or not, with the exception of Biden, and even that was kind of curtailed, the IRS's budget has been constrained a lot. Even today, their technology is very antiquated. You have to do something pretty substantial to get their attention.
Yeah, I was just gonna ask, like, what triggers, I mean, I worked in the music industry for a long time, and my boss there, I mean, he's been audited like 3 or 4 times.
Well, and so there are, okay, so in the different industry, there are what's called DIP scores, and it's like differential something, that it stands for. But let me use construction because I know builders better than anybody. If you have, like, if I have a builder and they'll have ratios that they expect to see between revenue and cost of goods, which is building materials. And if you exceed that, so let's say you did 400,000 in revenue or 500,000 in revenue, but your cost of goods sold was 600,000. That would have been too much for that amount of money. And then you had labor of 300,000. And they would expect your labor to be closer to 20%. and for your building materials to be under 50%. Because most builders are trying to make a 20 to 25% profit. So every industry, whether you're a mechanic, a hairstylist, in arts, music industry, whatever it is, they're looking for, and here's the thing, how do we file? How does everybody file now? Electronically. So you file and that computer's instantly tabulating, you know, like if your charity expense exceeded your income, audit, right, audit. Doesn't mean it's not legit,
Yeah.
but audit, right? And so they compare all these different things. You're a household of 5 with 3 children and you have no taxable income. Okay, maybe an audit may not be, but you see where all this is going. So they're comparing your adjusted gross income, your total income to all these different characteristics. And specifically, with sole proprietors, they're checking your auto expense to your income. Everything's getting compared and cross-checked. And if you exceed too much, too great of a delta, or you have too many discrepancies between multiple different sources, then you can trigger and so let's digress here real quick. There are different levels of audits. Okay, there is what's called the mail audit. We've all gotten a mail audit. You made a mistake. Now you have to prove that you didn't make a mistake, that they didn't account for it correctly, or you did and you paid the tax, one of the two, okay? Everybody, just about everybody will get one of those if they haven't already. My name's Kevin, I've gotten them myself. No way I'm getting math error. And so the next one is what's called an office audit. And an office audit is where, like, did you say friend?
Yeah.
Okay, so your friend, when they find a mistake in one year, then they start looking at other years for similar mistakes or intentional things. And so they may do a mail audit, you agree to it, then you get notified of an office audit, where now, because they've uncovered enough money, think of the IRS as like a business. They're not into nickels and dimes, they're into thousands of dollars. So if they see that you owe thousands of dollars, now they're gonna look at your other tax returns that are within the audit time period. And the audit time period is 3 years from the point you file, which is really 4 years, if you think about it. So like you'll file 2024 in 2025. So 2024 is gonna be available in 26, 27, and 28. That makes sense? That's 3 years. So really it's 4 years worth of tax returns during a 3-year time period. Now, if you extend, that gives them more time. I am a proponent of extending. I believe that you don't want to be part of the bulk, that you have a higher likelihood of an audit, just a random audit. But they don't really have the personnel for a lot of random audits today. It's usually they're comparing, cross-checking, something's off, and they want to talk to you. Most mail audits are like, you put down that you made X number of dollars and you had a federal income withheld of this much, and that's not what they have. Or you forgot a W-2 that you forgot about and didn't put in, or you didn't include interest income from a bank because you just didn't think about it, whatever, dividends, whatever it is. And then they'll just say, and here's the bad news. The bad news is, do you think they send that to you in May after you filed in April? Could they have, most likely? They're not gonna send it to you for like 2 years because they want the interest and penalties associated with it. Yeah,
You're talking about their matching. though.
yeah, they're matching it. Yeah,
You also have the opportunity as a taxpayer to go online and get a copy of your.
transactional file.
Yeah, which will tell you everything that the IRS has.
Yep.
So it's a good way to.
It's a good idea. Yeah, I've never done it myself personally, but I know it's there. So, yeah.
Yeah, I do it every year and I rely on that.
Smart. Yeah.
You're trying to get ahead of what documents they may be sending you?
Well, you may forget. So
Oh.
Yeah, within a year following the year that just ended, you can get that report that will show you every W-2, every
Oh,
bank account, every brokerage account, just all the transactions that they match.
And I will tell you that the interest rate that they work with is not a high interest rate. But if you had a big mistake, right? And it's just, for me, it's a personal annoyance because I know they could have sent the notice out much sooner than they actually do in the end. And every once in a while, I'll get one that's early. You know, every year, one of my clients will, I got notice, what did you do? I didn't do anything, you didn't give me a document, so that's what happened. We've got one right now where, this is probably the biggest one I'm dealing with now, is because there's not really a huge tax benefit to holding on to a dependent to like 26 years old, even though you're paying for them, maybe go to school, you're paying their medical, their health insurance, things like that. There's no real tax deduction benefit as much as letting them be independent. Because like if they're your dependent, they're not getting the Tabor refund in the state of Colorado. So we're finding that the biggest mistake that's happening is where a person files on their own or they don't file on their own, and then there's a discrepancy with the parents in filing their tax return. Because the kid filed it right away, and they wanted a refund, right away. Well, in some cases, like with one that I'm dealing with right now, it was more beneficial because of the college education deduction on their tax return and their tax rate than it was for him to file on his own, and he was living at home, so he was a legitimate dependent. And it was cheaper to lose the $800 Tabor refund so that he can get back thousands more dollars on the parent's tax return. So then we had to do an amended return for the kid. So we do the amended return for the kid, but we can't get the parents to go through for the life of us. Because it still shows that he had claimed himself as a dependent. So that's how that technology is really behind. They'd already received a letter from the IRS because he had to mail it in. He couldn't file it electronically, he had to mail it in. It took 4 months just to get that back stating, okay, this is done. And so we're still trying it. And so now he's got to go to the taxpayer advocacy to try to get his tax return recognized, so he can actually get it filed, recognized, that it's good to go and get his refund. All right, so back to audit risk. So yeah, there's an audit risk. It's not super high unless you really do something that's out of the ordinary. I would say for most people, if you had $100,000 of gross revenue and you had 40,000 in expenses, you had 60,000 left over, you're going to get what's called a QBID, qualified business income deduction. It's 20% of that number. So now you're going to get a 20% deduction that's tax-free. That's what NAR did for you. That's what they lobbied for you back during COVID. And so that would be what on 60,000?
So you said this is for making over 100,000 a year?
No, this is just whatever, I just used an example that you grossed 100, you have 40,000 expenses, so you're left with 60,000 net profit. You're now gonna get a 20% QBID deduction, which is 20% of 60,000 is what? $12,000. That's $12,000 tax free. Now, if you did 200,000, it'd be 24,000, right? I mean, that's a big deal in my mind. To say, I mean, that's tax-free money. And that's the thing, it either sunsets in 2029 or 2027, I'm just not remember which one right off. As we get closer to it, obviously that'll be top of mind. That's the biggest thing right now, whenever we're talking about tax strategies and the ways that we're doing things, is they're not typically passing tax. There's two things to be aware of. One, they're not passing tax legislation in a timely manner, meaning a lot of times we'll be at the end of the year, they've got tax laws that they're looking at doing retroactively, and it doesn't get passed until January. And so, you know,
So with the QBI benefit,
QBID,
that is there's a greater benefit to being mindful of writing off less expenses to have that difference.
no, not in the end.
Okay,
You're better off writing every piece of deduction you can.
Okay.
Where the benefit is that you're gonna have a higher net profit as a sole proprietor than you are in an entity. So the QBID deduction for entities typically aren't as big as sole proprietors in the end, because you're gonna have W2 wages that you're gonna take off, and so your net profit's a lot smaller. So the QBID deduction is gonna be significantly greater
Okay.
than if you have an entity, depending on what your volume is. I mean, if you have $1 million year as an entity, no, it's probably gonna be better, in the end. And there are limitations to how much you can take as well. There's a formula. It's a very complicated, thank God for computers. It's a very complicated formula to figure out. When they first came out with it, I was like, good God, this is crazy ridiculous. So, where's that going?
The QBID is not as beneficial to have an entity
Yep.
versus.
Was running through example,
Around pros and cons.
give pros and cons.
Yeah.
So I apologize, I lost it. And we talked about audits, legislation. So what you need to understand is that if you're calling a tax professional, the problem that we have a lot of times is that we're like, we don't know yet. All we can work off is probabilities. We believe the legislation will pass. We believe it will sunset. We believe it won't sunset. The problem is they wait now so much to the tail end, and they don't pass legislation like they used to. Like, it's not tax law. It's like, we agree to do this bipartisan, but temporarily. And so, it's not like the $500,000 capital gain write-off for your personal residence. That's law, it's in place. They would have to go through a serious legislation to get rid of that. What they do is they convince other people to pass it, but only because we're only gonna do it temporarily, and then we'll decide if we're gonna allow it for a longer period of time or not. And most tax laws being passed that way. So like literally, I'll have a binder this thick, which I used to get printed, but now I don't. And there'll be like 3 sections, and it'll be like, stuff that is sunsetted, stuff that is in, this is the last year that it's going to be here, and then stuff in the future that's going to sunset. And what the probability is that of it continuing or not continuing. Because there are people, I mean, this is millions and millions of dollars of tax strategies that people have to figure out. When they passed this last tax legislation, I literally had to take a sub S that I've had as a sub S for over 2 decades and convert it to a C corporation. And I had to take my C corporation and convert it to a sub S because of where my medical expenses were being written off. Which entity was making more money to cover that as employee benefits. And so I had to switch it. Well, guess what? That sub S, that's a one-way trip. You can, everything is set up as a C corp, then you can convert it to a sub S, but when you convert it back, you're done with that company. I'll have to set up a whole new company now if they sunset the legislation. And now all of a sudden, it makes more sense for this to be a C corp. I'll set up a whole new company. Well, when am I gonna know? At the beginning of the year? When I can plan? Or at the end of the year when they go, yeah, it didn't pass. We didn't agree to keep it going. And that's usually what happens. They don't get enough votes to be able to keep it going. It sunsets at that point. Does that make sense? So it's aggravating from a strategy standpoint. I'll take classes in October and November, which I'm coming due. And there'll be a lot of this, here's what's going to be sunsetting. However, we believe it's going to not sunset. They're going to agree to keep it going. But if they don't, well, we got to move money around in anticipation of what's going to happen or not happen. And if we do it after December 31st, it's too late at that point, legally. So that's the frustrating part, and that affects all of you in some form or fashion with how you're deducting things. All right. So when you get to a certain point that it makes sense to look at an entity, there's, like I said earlier, there's 2 reasons. One is from a legal standpoint to insulate your other assets and other businesses from the activities of this particular business. And guys, I will tell you right now, I've been doing real estate for almost 30 years, and COVID changed the legal landscape of real estate. And what I mean by that is that I've owned a brokerage at that time for about 14 years and had owned this one for a few years, 4 years, a couple of years, like 2018. Well, what happened during COVID is when you have extreme markets, and for those of us that work the extreme market, we had sellers that would not do anything. And everything was pound sand. And we had buyers that were paying 10, 15, 20, 30% over appraised values to get into properties. It created this landscape of almost hatred. And I'm going to say, knock on wood, I had maybe 1 E&O claim before that, maybe 2 at the most. We won all of them. We have had more E&O claims in the last 4.5 years than all my years prior to that. And a number of them we've lost. So it's driven the cost of E&O insurance through the roof. We're in a very litigious society, and it's not just. The brokerage firm gets caught up into it, but you as a broker get caught up into it. And we've had 2 occasions where a broker wasn't covered by E&O because they didn't do their job right. And so that means they're personally exposed. And if you're running it as a Schedule C, that means you and everything you own are personally exposed at that point. So 2 reasons that people look at entities, and hopefully it's the combination of the 2 that makes the most sense for you. One is legal. So if you have a lot of, and when I say assets, I'm talking about money, I'm talking about stocks, I'm talking about real estate, I'm talking about property. You know, if you have a lot of that out there, all of that's on the table. Now, if you have an entity, then there's a higher level of responsibility that must be proven. Meaning they've got to prove gross negligence or intentional fraud. Like you were out there intentionally trying to harm people. And I don't think most of us would be in that boat. You know, there may be some rare exceptions, but I think most of us would be like, it was an honest accident. Yes, there is, you know, accountability that needs to happen, but now it's going to limit them to what's in that entity. And all of my entities, with the exception of the entities that have a real estate property in it, are cash flow entities, right? They may have some personal property, but that's it. Sorry, I'm gonna spit on you. They may have some personal property in it, but that's about it. It's not going to have a lot of other things other than cash. And by the way, I drain my cash each year. By the way, Berkshire Hathaway, he drains his cash monthly out of his entities. Oh yeah, and that came out in the settlements. Because it was like, I don't know what they're gonna get out of Berkshire, because Berkshire has nothing in it. They drain their accounts monthly. You know, I wait till the end of the year and then I drain my accounts.
Where do they put the money then?
It cash flows down to me. So on a personal level. But if they're suing my company, they're not suing me personally unless they can prove gross negligence or constructive fraud. So that's number 1. Number 2 has to do with tax advantages, minimizing your tax liability, not avoiding tax. Okay, that's against law, but minimizing the taxes that you owe by using the tax laws. Now, there are. What is the entity that most of you think that you're going to set up? Come on, what's the LLC? Everybody loves LLC. LLC is not recognized by the federal government. Okay, it allows you to, since LLCs are a state entity. The reason they came into existence is that people were setting up partnerships and they were trying to set up limited what do they call them?
LLPs?
No. Partnerships where you have a, not a managing member, I keep going back to LLCs. General partners and limited partners, okay, that's how partnerships are set up, general partners and limited partners. The problem is the way a lot of the tax laws worked, limited partners were still exposed. And so people began to realize there's a lot of people that have a lot of money that would love to invest, but they don't want the exposure. They want to limit their exposure to whatever they've invested in the company. So I always make up some example like, you know, LeBron James wants to, you know, he's got a buddy from high school says, hey, I got this great idea. You know, why don't we get one of these abandoned malls and we'll do like a paintball thing, but instead of paintballs, we'll use slugs. Okay, we'll have real body on them. All right, what could possibly go wrong, right? And so he decides he'll invest $1 billion into this, and then somebody dies. Right, well, usually what happens is that if it was a partnership, the goal was only the general partners would be liable. But they were able to penetrate and get the limited partners too. And so they said, okay, we gotta think of something better. So they came up with LLC, limited liability companies. And these limited liability companies, they changed the names of the people that were playing, but they also wrote stronger state laws, because it's a state entity, it's not a federal entity. And they made it really clear. You've got managing members and you have members. Members have zero say. Literally, they have no voice whatsoever. But they can have the money. Managing members are on the hook. So I look at it as like, okay, you got like, most of my companies have 3, 4 managing members. Some have just one. But most of them will have more than one in case something happens to one of them, we have others. And don't do anything to me. I want to hang around. We actually have, one of my companies actually took out a insurance policy on me. Up in Evergreen. I have a $500,000 insurance policy if I ever die. Then they have money to go hire somebody to take on my duties. And then I had one company that said, we want you and Val to stop flying together. I'm like, well, that's how we ended up with the insurance policy, because I said, no, that's not happening. I'm not sitting next to a stranger on a plane for hours. So now when you have a limited liability company and, you know, the LeBron says, hey, you know, sounds like a great idea. Maybe we can have a roller coaster there too. Shoot from that. So then, you got the guy from high school, he's the managing member. Right? Because here's what's happening. If something like that happens, what are they trying to do? Pierce the veil and go after that person. Right? Well, that's the one that has the money. And then the other one's protected. In some states, even the identities of the members are hidden. You don't even know who they are, you can't find out. Right? Because they're protected. And so that's what made LLC so popular. Here's the part that I have to chuckle at. Like, I have some limited liability companies because I have multiple partners in it. If you have a limited liability company and it's just you, who's the managing member? You. So why are you setting up a limited liability company when you haven't limited anything, right? You really technically aren't a partner, so you're not a partnership. Technically, you could be taxed as a sole, you can have a limited liability company and be taxed as sole proprietor, just so you know. So you can set up a limited liability company for the legal protection of your other personal assets and then do a Schedule C. That is possible. You need to work with an attorney on how to do that right. In my cases, my limited liability companies that are just me, they're a C Corp or an S Corp. And so here's what you need to take from this. We're going to talk about limited liability companies. But how they're being taxed is either C Corp, S Corp, or partnership, or sole proprietor, those 4. So even though I'm going to start talking about sub S and C Corps, it can be a limited liability company. It's just being taxed as a sub S or a C Corp. Does that make sense? So that's how you need to look at it. Because the federal government does not recognize LLCs. LLC is just a name on a corporate tax return, or a partnership tax return, or your sole proprietor, Schedule C. That's it. Now, the 2 biggest, so who here has multiple people owning your business right now? Okay, so partnerships out, so we don't talk about partnerships, okay? So it's either gonna be a sub S or a C Corp. So let's talk about the pros and cons of sub S versus C Corp. If you set up a corporation and you don't use an attorney, I think you're making a huge mistake. However, I used an attorney on my last one and they still didn't do it right and I had to fix it later. Everybody is initially set up, if you put in to be a corporation, you're initially set up as what? Which corporation? Nope. So that's the other one, C Corp, right? So everybody is automatically a C Corp. Then you make an election to be a sub S. So everybody's a C Corp, then you make an election to be a sub S. Now, I will tell you, back in the day, so this has been back in late 80s, early 90s, maybe even mid 90s, IRS was tough. Like, you set up a C Corp and you had 2 months to get your election in. If you didn't get your election in, you were C Corp until the following year. And then you had till, I believe it was February 15th. You had the first 1.5, not 2 months, 1.5 months to make your election. And then the window was closed again. Now you can actually, I set up a company, I think I told you this, I set up a company in like 2020 and I wanted it retroactive to 2019. I not only got to set it up for the beginning of 2019, I got to make an election too, and with sub S. So they've really lightened up those criteria. and restrictions on what you can do, and I'm not kidding you, like. I remember some of my clients, like, I would send stuff in and then they would reject it, and I had to prove that it was mailed on time with the, you always did stuff certified mail. In order to get the election recognized, it was ridiculous, absolutely ridiculous, you don't have to worry about that as much today as back then. So it really is the friendlier, more cooperative IRS versus what we used to see in the past. So what's the biggest differences between C corps and S corps? I'm gonna start with C corp, because I think most of you will not be a C corp, I think most of you will be sub S, and I will tell you what's gonna differentiate, yeah, go ahead, Kim.
How many people in here are C corp compared to S corp compared to just a sole proprietor?
I know in the beginning, well, most of the people in here are sole proprietors.
So how do you move up to C corp or S corp, what's the dollar amount?
So I think it really differs for people, I think if I had to guess, I'd say it's more legal and concern on the legal side of it than it is a dollar amount. But we just used an example earlier and Jeff, sorry about that, I knew it was you. And so Jeff said he's one that pays somebody, he pays about $2,000. Well, in reality, if you really were to pay somebody, like for most things, I'd say you're probably gonna spend more, 3,000 to 4,000 for all the different forms and, rigmarole, and if you hire maybe you hire a bookkeeper, maybe you don't, but you hire a payroll service because you don't want to muck that up, it's a pain. Once you muck up, have you ever mucked up the 941?
Yeah.
Yeah, it's a pain in the ass to get fixed, isn't it?
Yeah.
It is right there alone, I tell most of my clients, hire a payroll service, they're not gonna mess up your payroll, because once you mess up your payroll, it doesn't take weeks, it takes months to get it figured out correctly, because the mail's passing each other. When you send it back and forth, they're sending you notices, you pay the notice, now you've overpaid, they wanna refund you the money, it's just a mess.
So it's more for if you have
What's
an
that?
assistant or other people work with, instead of just doing your own.
I still think it comes down to your mental acuteness, it's not the right word, acuity, as far as you being able to handle the complexity of what you're doing. And I can tell you right now, like I was talking about one, her name was Kim Bauer, and she just flat out, after I told her all the stuff that needs to be done for corporations, she's like, Kevin, I'll never, ever do an entity, I will be a sole, I don't care if I make $500,000, I'm gonna be a sole proprietor. And that's where their head is, it's just too complex for them, it's too many forms, don't wanna mess with, don't wanna pay somebody to do it. They're just like, just give me the easy button, I'll pay the taxes.
Okay, so that, I hear that, but like, if you are making, let's say you are making $500,000 and it's killing it in real estate. Are there, like, is the benefit of paying someone in a tax
Oh, hell
savings
yes.
greater?
Oh, hell yes.
Okay,
Yeah, for me, so I'm these two. For me, I was never a sole proprietor. Like out of the gate, I had my entity in place, but it's not work for me. Right? I'm gonna run my books whether I'm a sole proprietor or I'm an entity. And I know the benefits and understand the benefits of it, and so it doesn't cost me anything. So that's what I'm saying. I don't know that it's a dollar amount, Kim. I think it's more it's a stress work. If detailedness is not your thing, keeping separate accounts, making sure you're writing the right checks out of the right account, keeping a P&L and a balance sheet and all that stuff, that's not your thing, then I don't know where that dollar amount is. It could be 100,000, 200,000, 300,000. You will save money at 100,000. But I just don't know if it's worth it to most people. Go ahead.
That was gonna be my question, aside from all of that, at what point gross net income does it?
I would say gross 100 and you should be netting 40 to 50 off of that
Okay.
in the end. I'd say that's about break even, and then for other people, but then if you're buying leads, now all of a sudden that's going down, and so it just depends on how you run your expense side of the equation. Like mine is all my businesses are very lean on the expense side, like, I've been accused of lots of things as far as,
Being cheap.
yeah, that. And so from, here's the latest that I'm getting crap over, is she on the call? No, the latest is my truck. So for those of you who've been in my classes before, like when I teach wealth building, I talk about vehicles, and we're gonna talk about vehicles here in just a little bit. And you gotta decide whether you're gonna write the actual cost off, or if you're gonna write a mileage deduction. You gotta keep track of mileage no matter what. But which one you're gonna do? And they're like, well, what do you do, Kevin? I said, I write actual expenses off. And they're like, well, why? Because I keep my vehicles forever. Like, I'm not kidding. Like right now, I am 60 years old. My primary vehicle is 20 years old. A third of my life has been spent with this vehicle. I've only been married for 35. Right? I mean, and my wife's like, for the love of God, go buy yourself a vehicle. And I'm like, it'll probably be my last vehicle. I gotta be really selective here, guys. I'm not just, but the problem is my TM truck has been breaking down lately. And yeah, so, you know, I'm looking at that Hummer, the crab walks. And I'm gonna look at this and say, but that's my last vehicle. And so most likely. And so, but she's just, she's coming from love, because she gets a vehicle every so many years, and she's like, I'm tired of hearing you getting towed by AAA. My son's a mechanic and he works on it, but even he came up to the house Sunday and he's like, so Dad, they don't make the part for this vehicle anymore. So I'm kind of jury rigging this to work. And so now I'm test driving my truck around here. So if it breaks down, I got AAA versus like the trip to the airport coming up. It's gonna be like, I don't know. Leave my truck on the side of the highway for some random tow truck guy to pick it up. So that's why. So for me, getting the entity was a no-brainer. For others, like Kim Bauer, she's not in real estate anymore, but she was like, you know, all the forms and everything, and whether you pay somebody or not, you're still boots on the ground. You're still running your business account, your personal account, you're interacting with it. You know, how do I get money out? You know, how do I do a net payroll check if I don't hire a payroll company to handle it? There's just complexities to it that you have to decide where your break even is at. For me, it was 0. For others, it's 100,000. I don't see it under 100,000. I just don't see any benefit for most people, other than, you know, you're a trust fund baby or something, or your spouse is making substantial income, or you have a lot of investments that you haven't separated out into separate entities. Then you may not want to be exposed in that, your business activity. Does that make sense? So then you do want an entity, regardless of whether you're saving money or not. Maybe you're spending money, but it's worth the protection that's there. All right, so C Corp. A C Corp is still a situation where if you don't drain the account at the end of the year, you could be double taxed. Because what ends up happening is that whatever you leave in the company that's profit, you're gonna get taxed on, and then down the road, if you decide to take that money out, you drain it, now you're gonna get taxed again at the personal level. So it is truly double taxation, yeah.
I just don't get what it is. Like, I've never heard of C Corp before.
It's C Corp is your basic corporation. I don't know what C stands for. Classic, we'll go with classic corporation. I don't know what C Corp stands for, but the C Corp, the corporation, well, there is a PC, which is a,
Professional corporate.
I was gonna say personal, but professional. There is what's called a PC, but most people, even though we're service oriented, which technically we should be a PC, most of us are just C Corps. We have a C Corp. Personal services, that's what it is, personal services corporation. So it's just your standard corporation, you're gonna be treated as a corporation. With the corporation, if you have profit, you get taxed on it, and then if you take it out the following year, you get taxed again at your personal level. So you don't wanna leave any money in your corporation in the end, you wanna bring it down to break even.
So can I ask, you said you take your money out at the end of the year, did you do that in your S Corp as well?
Yes and no. I write a lot of hot checks at the end of the year with deposits coming in January from a cash flow standpoint. And so it may show that it's negative, but it's not really ever negative. It may show it. No, I take that back. My S Corps, I don't, because I'm taking dividends. And I don't have to take the dividends by year end. I can take in the following year. I'm still taxed on it in K1. But I don't have to cash flow. My C Corp, I do. Typically my C Corp will go negative for just a short period of time, and then it's immediately going back to positive again, because I'll have some checks that I'm ready to deposit, you know, from December into January. Oh, that's the other thing. A con for sole proprietors is your 1099. So there's that file system with the IRS. We are required to send you a 1099 so that the IRS knows that we paid you this much money through the brokerage firm. And so they're looking for that amount or greater on your Schedule C. As a corporation, we don't have to send 1099s out to them, and we don't. So we don't, as a business, I don't send I'm not helping the IRS on any level that I don't have to help. It's not required, I don't do it. So we do not send 1099s out for businesses. The reason I bring this up is therefore then as a cash business, not an accrual, cash basis business and not an accrual basis business, I'll defer my income at the end of the year into the following year, but I'll front load my expenses. So like I'll prepay my company cap. I'll prepay as much stuff as I can. I'll prepay Visa if I can prepay Visa. Like I'll go in and look and see how much I owe, but my bill's not quite due yet, and I'll send that in. Or I'll cut the check and then I'll mail it in later. So it's maximizing my expenses, it's minimizing my income in the end. Let me think what else. So with the C Corp, you don't want to have profit. You can have employee benefits. You must pay yourself a comparable wage for what you're doing. Now that's a big word, comparable wage. What does that mean? Can you go into the IRS code, the Internal Revenue Code, and is there like a matrix where you can look up real estate broker and X number of hours and this is how much? No, it's not. What it is it's a very ambiguous definition that if you were to not work and you were to pay somebody else to do what you're doing, how much would you have to pay them? That's basically the definition. Okay, what would you have to pay somebody else to do what you're doing?
Is this concept you're talking about more in the S Corp world or than the C Corp world?
No, we'll get to that though. It's both. It's both in the end. Well, here's the deal. Yes, it is more sub S than C Corp because you're gonna drain your account anyways, and how many ways can you take the money out? Right, now, it is possible that you would be better off taking $750,000 W-2 versus taking 400 and having profit, which is double taxed, right? As a W-2, I'm gonna be taxed at a rate of 15.3% for FICA and Medicare. And then federal and state income taxes of whatever that ends up being on my personal tax return. But part of that goes away, right? You get capped out at like 140,000 or something like that with your wages. So now the IRS would feel more benefited if I was paying a 35% corporate tax. And then that came over and I paid federal and state taxes also. They're gonna make more money that way. So it can affect both, but it's more for the sub S. And when I get to the sub S, I'll explain why. Because you can't take dividends unless you have a comparable wage. And the most likely with C Corp, you're gonna take it all as a wage, because unless you are dealing with $1 million worth of profit to be figured out between your wages and constructive dividend, it's most likely to be all wages. So, employee benefits. So C Corp, for me, there's only two reasons that I have a C Corp. One is employee benefits, which breaks down into two categories. So it's really one category, two subcategories. One has to do with funding a SEP. I have my SEP is 100% funded by the company. And two, my health insurance and medical expenses. Now we can write health insurance off as a sole proprietor, but we can't write medical expenses off. Matter of fact, I think if we even can, I don't think we can anymore. It's like 10% of your HDI is the floor, and then you only get what's above that on a Schedule A. And most of you, who of you think you itemize today? Right? Everybody's taking the standard deduction because of the tax law that was passed, and mostly that's because of the SALT limitation. If we didn't have a SALT limitation, I think a lot of us still would be itemized. I itemize, but it's for a whole different reason. It's not because of mortgage interest, and it's certainly not because of the state and local taxes. All right. So with the C Corp here, so how do you decide whether we want to be a C Corp or a sub S? Employee benefits. And employee benefits, which is the medical and health insurance, and then my SEP. And SEP, by the way, there is a way to manipulate SEP through a sub S, just so you're aware.
What is this?
SEP is a simplified employee pension plan, which is, I like it much better than the 401k. There's no fees to it, and it's better than an IRA because you can get up to 25% of your earned income up to $1 amount. I don't remember, I don't know what the dollar limitation is, but there's a dollar amount you can deduct up to. A 401k, you end up, I think it's about the same. But actually, I think it can be less even, I don't think it's even as high as an SEP, but it's managed, and so you have to pay a bank or somebody fees to have the 401k plan. And I've done steps since I was like 24 years old. You know, that's just been the one I've always resonated toward, so. How many of you have a spouse that has medical benefits through their job? Okay, so you guys are out already, and Kim, I think we talk about that every year. Your C corp makes no sense. So for the others, how are you paying your health insurance and your medical expenses? How are you handling that? Are you just paying it out of pocket?
I'm dual career, so I have my other job.
Okay, so you're covered, so you raise your hand, okay. So when I said spouse, I meant you or your spouse. So who is getting pre-tax insurance benefits right now? Just health insurance is covered and you're getting it written off either through yourself or through your spouse. Okay, so 4 of you. So how are the rest of you doing? Do you not have health insurance?
No, okay.
Yeah, it's a lot.
It's what? It's a lot.
I said we pay a lot.
Okay, so you're not deducting it, or how are
We
you?
are deducted, we're an S corp.
Okay, but you're not deducting it in your S, because S can't write off the employee benefits. So how are you deducting it?
I don't know.
So what's happening
I
is,
tell my CPA and she does it.
so what they're doing, just so you know, here's what they're doing. What they're doing is you're still paying self-employment tax on it. As a C corp, I'm not paying self-employment tax. It is a 100% employee benefit, like pre-tax, period. As a sub S, you're not deducting it on your corporation. What you are doing is you're passing it through on your K1 and you're deducting it on the front page of your 1040. But you still pay self-employment tax on it, 15%, 15.3%. That's just the way it works. I'm just letting you know.
Yeah.
That's why I have two. I have a company that's Val's company that brings in money, and the big chunk of it is for employee benefits. Then I have my company, which brings a lot more money in, but I can't write off employee benefits, but I can have profit and get my QBID. That's why there's two. Does that make sense?
Yeah, so I
Okay.
could do two.
If you have two income streams, do you have two income streams that you could run through? You gotta think creatively. Could you have a residential real estate commission income and maybe a commercial, because you wanted to separate your commercial from your residential risk? Sure. Right? And then you set this one up so that he would make the most sense, is the employee of the commercial, and he has a wage, right? Still gonna have a wage, but he has this employee benefit package. Right? Now over here, like I said, my step is in the sub S, her step is in the C corp. So she has a step, but it's usually smaller because her wage is smaller because of the employee benefit package and the income's less. Over here, I can't write off medical, now here you can write off your medical out of pocket expenses. It's huge. Like for a while, I don't know about you guys, but post Healthcare Act, Obama's deal, right? Post his deal, my insurance went from like $400 a month for a family of 7 to $2,000, $2,400 a month for health insurance, and my deductible over here was like $1,000, and then I had to up it to 5, 10, 15. So now where I'm at is just me and Val, we're at $1,800 a month plus a $5,000 deductible today. So, but I can write all that off in the C corp. Right? If you're a sub S, you can write off the medical expenses. It's not going to be against the income in sub S, but it'll come down onto your personal tax return as a K1, and it's written off on the front page of your 1040. So you still get it.
Yeah.
But the medical expenses, unless you're having cancer or, heart attack or something, did you have big bills? Huge bills or anything health wise?
Oh, yeah, with my surgery.
Yeah, but what was your deductible in the end? Is that all? Okay, let me ask it a different way. Out of pocket costs, do you have enough for it to make sense on your tax return?
But that was years ago though.
Oh, okay, all right.
Yeah.
So I think right now, and I'm on one side of my head saying it's gone completely, and the other side of my head saying I think it's a 10% AGI floor, and then you can get anything above that, and it's on your schedule item. Basically, you don't have the ability to write off medical expenses, other than health insurance, that's it. Does that make sense? So your CPA is just trying to keep it simple for you. Yes, we wrote it off. Technically, they didn't write it off in the business. It flowed down on your K1. It's a little item on your K1 and shows up on your personal tax return. So if you have high medical expenses or you have high health insurance, we needed the C Corp. I mean, we were spending $35,000 a year on health insurance and medical deductibles for, kids are at, play sports and stuff. We spend our time in the doctor's office. And trying to convince them that we do not abuse our kids. They did it on their own, completely, it wasn't us. So for us, what does that represent? Well, it represents roughly, and this is just roughly, 15.3% of the total, 35,000, and then another 30% of the medical expenses, right? So 15% of 30, let's just use it 30,000. That's $4,500 plus another 30% of say 10 grand. That's another 3 grand. So that's 6,500 right there, right? For a C Corp. Now I can't take dividends, but that's the benefit of a C Corp. So if you have, now if your medical expenses aren't that big, like when does Medicare kick in? I'm 60, it's coming soon. Okay, so 65 is when Medicare comes, then my insurance is gonna drop substantially. And the C Corp it doesn't have unless I start getting a lot of operations or something, it won't have the same importance at that point. So again, if you're younger, how do you handle your health insurance? Say that again.
Right now, it doesn't.
Medicaid, okay, is that kind of the parachute for if you don't have, okay, health insurance, who else didn't raise their hand? Yes, love. What,
I did raise my hand.
oh, you did, forget it. Yeah, how you handle your health? Just fill in the,
I just pay an individual.
okay, so do you mind sharing some numbers? What do you pay in on month and annually, how much do you have out of pocket costs, or what's your deductible? Approximately,
I think I pay $1,000 a month.
Okay. Yeah, I'm like 900 or something.
Yeah,
And do you know what your deductible is?
I think 5.
Okay, so 5 grand, okay, so, and have you maxed your deductible out in the last few years?
This might be the first year.
Okay, so that means this year,
Plus.
you have $17,000 worth of medical and health insurance benefits, expenses. If you were a C Corp, you would be able to write off all of it. So let's round it to 20, if that's okay, it's 17, but we'll round it to 20. So if it's $20,000, you would say, 2,000 plus about $3,000 in Medicare FICA tax, because it's all pre-tax.
Right.
And then 5,000 at 30%, which is 1,500, so you would save $3,500 if you were a C Corp. And again, you have to, this goes back to Kim's question, well, when does it make sense? I don't know. You gotta pay $2,000 minimum to get the 3,500. So you're really only saving about $1,500, roughly, ballpark. Now, we could get into, well, but then that's a write-off and we save the tax on the 2,000, I'm not gonna get into the weeds, right?
And with those numbers though.
Yep.
After your $5,000 deductible before that, is it like a 80-20 or? And then after 5,000, then they cover it all?
Yeah, that's the way mine is, except for drugs, except for prescription, they cover it all. That's why if you're smart,
That's better than a full-time, like, that's better than our benefits for somebody working for a corporation for 20 years.
well, that's why it's kind of like,
That's crazy.
it's like charity. Like I always tell people, when you're doing charity, do it in December. And then tell the church that's for 2024 and 2025. That way you're taking it all 1 year. I mean, that's serious, this is what I do, right? Same with medical.
Say that again?
So I tithe
Right.
every other year for 2 years, all at the same time.
For the current year and the year coming.
Yeah. And that's why a lot of times I'm itemizing, not because of mortgage interest, but because of my charity gift. I pop it for 2 years in December for one tax year. You do the same with medical. Like, if it's a bad year, get it out of the way. And by the way, even if it's not covered, like optional, what do you call them? Optionals?
Elective,
What is it called?
elective.
Thank you, elective, optional. It really wasn't optional, I wanted it done, but elective type stuff that's not covered by insurance, that's all covered. Everything's covered by my corporation, it's all part of my medical benefit package. Does that make sense? So that's C Corp. Now, C Corp sounds really good, but back to your point, what's your first name? Eric, back to Eric's point is, but now you gotta take all his wage, you're right. So we'll run through some numbers, you know, like 300,000, 400,000, we'll see what that looks like. That's the pros of that. The negative is you can't take a dividend without paying tax at the corporate level, that's a negative, okay? Otherwise, the corporations have the same legal benefits, et cetera.
Can you repeat that? You can't take a dividend?
You can't take a dividend in a C Corp without being double taxed. You get taxed at the corporate level, and then when you do take the money back, you know, personally, you're gonna get taxed again at the personal level, so it's a double taxation. All right, and if you get into really high income, they do look for what you have a profit. Let's go back over to the sub S, and by the way, I'm cutting you down, unfortunately, you're gonna get short, whatever you call it, what's the term, short changed. Well, I'm having a hard time with words, short change on expenses, so I'm really gonna hit the expenses like hard, with just the unusual ones. All right, so now on the sub S, you can't write employee benefits on. Now, do I pay my health insurance out of a sub S? No, because I have a C Corp, but if I didn't have a C Corp, I would. However, it's gonna still flow down on the K1 as income, and then I deduct the actual, insurance costs on the front page of my 1040. So you're not benefiting from the 15.3% savings of FICA tax. It's really post-tax dollars in the end. And now you're just saving federal and state. On the SEP, I would pay it through the sub S, but again, it's not an expense of the company. It's gonna flow down and I'm gonna take the deduction on the front page of my 1040. Does that make sense? So sub S, you can't get employee benefits if you own 2% or more of the company, which I like to think you own 2% or more of the company, right, in the end. So what's the benefit of the sub S? The benefit is dividends. And this gets back to the comparable wage thing that Eric brought up. And that is, we have to take a comparable wage. So let me take you back in time. I graduated from college in 1989. I got my master's degree in 1991. The thing that we did, because this was the tax strategy for CPAs, lawyers, doctors, is we had sub S, we set up a sub S, we brought our income in, and we took a wage and dividends. You know how much my wage was in 1991? $10. I took $10 wage, and then everything else was profit, dividend. Well, the IRS picked up on this real fast, did some audits, one of them was mine, I got audited, and they said, yeah, you can't do that. Well, why not? Yeah, it's not fair, you need to take a comparable wage, and they actually changed the tax code because a lot of us and what we were doing. And so a comparable wage is what you would have to pay somebody else to do what you're doing. All right, and so the safe harbor that I usually work with is 2/3 wage, 1/3 dividends, up to a certain point where you can justify more profit in the end. So 2/3 wage, 1/3 profit, you're usually in a safe harbor. Now, don't get me wrong. If you're only talking about $20,000 worth of profit, it's all wage. You're gonna have a hard time convincing people that at $20,000, you can justify 15 and 5. I don't see that happen. All right, if I did the numbers right, but that sounds like I did it in 3/4. So you're not probably gonna get away with that. But you know, if you're up to, you got a $60,000 wage, 30,000 in profit, I don't see any issues with that, and have not had issues and have defended that in audits. So it has not been a problem. Where you do get into better is when you break 140, now you can justify higher profits. Okay, so like my profits in my companies exceed my wage, but my wage is really good. It's a high wage. Okay, so I'm okay from that standpoint. And also my dividends are coming from passive interest of other companies flowing through my parent company. So the benefit there is that, let's run through an example. You have $100,000 and you have let's say you have 50,000 in expenses, just for argument's sake. You're gonna begin to realize 100,000 is really a low number in the end. Okay, when I do this, $100,000, $50,000 worth of expenses. If I'm a sole proprietor, I'm writing off how much? How much of that am I writing off to be able to get my QBID? What amount is my QBID on 50,000? 10 grand? Okay, now let's do the corporation. Corporation has $50,000 in profit, of which I'm gonna take 2/3 of it as wage, so let's say I take 36,000 in wage, and 14,000 is profit. What's 2% of 1,400? 14,000. 3 grand. A little under 3 grand, right? It's like 2,800. So you see how a sole proprietor is better when your income's lower. As your income goes up, and let's say now you have profit. Let's say your net profit is now $100,000. Okay, that's your net profit. Your net profit's $100,000. What's your QBID deduction on your sole proprietor? 20 grand. On my business, on a sub S, what's my net profit? Well, now I'm gonna take 70,000 in wage and 30,000 in profit. Now I get 6,000, now we got a $14,000 difference, right? So you can see, for some people, they may never switch to a sub S. For me, it's very beneficial, and I need the legal protection as well, okay? And when I combine it with a C corp, that's a different story. So like right now, if you were only $100,000, if you were $50,000 net, but you have 24, 30,000 in medical expenses, that'd be a C corp. Screw the QBID. I'm gonna save more money on my medical and health insurance than I am, getting a $6,000 savings. You see where I'm going with that? So it's gonna depend, and that's why Kim, whenever somebody asks me, well, there is no set standard. It's your mental acuteness, as far as what you can handle. I still didn't do that right. Acuity, thank you.
Get it though.
Once I get it wrong, I just keep going down that road. Versus what benefits you actually get versus the headaches associated with it. By the way, with a C corp or an S corp, not only are you gonna do a tax return, not only are you gonna do more than one tax return, but you're also gonna have to fill out for payroll 941 quarterly, a 940 annually, a state unemployment tax form quarterly. You're gonna have to prepare a W-2 and a W-3 annually. Or you're gonna pay somebody to do it, one of the two, right? Yeah,
Are there any, like, QuickBooks,
there's payroll services.
that kinda, yeah, like a.
I don't know, QuickBooks may do it, I don't know, I've never used QuickBooks, I pay for a higher level bookkeeping system, and then my assistant, Valerie, that was the W-2s and the 41.
So when-
Bookkeeper does it.
I was gonna say, no, I was just gonna ask, so as a sole proprietor, you don't have to do all the quarterly stuff, which the C corp is.
You would do quarterly estimated tax payments based on your previous year's tax liability,
Okay,
and that's the only thing, so that's a lot easier than filling out a 941, 940s and all those ones. Questions on entities?
if I am currently under like Jamie, we have our own medical, or we have like under a partner. Is it not as beneficial to do a C corp? Is that what I heard you say?
Yeah,
Okay.
because really, you're only talking about your out-of-pocket costs,
Okay,
and that might be 5 grand, 6 grand, something like that. You're gonna be better off with a sub S or a sole proprietor, depending on your circumstance. And not worry about writing off those individual medical costs. Now, if you know a big one's coming, and most of us don't. But if we knew, like, the heart attack was coming, or I was gonna have an extended stay, or right now, like I am just screwed right now. I don't know how I found myself in this position, but my wife's been getting on me for a while now. I said, Kevin, I want you, like I'm that guy. Like, I don't go to the doctor. I just don't. And it's like, okay, you know what? I'm mortal. I need to start making sure things are okay. And so this was the year I was gonna really, I mean, I've gone in for checkups and, blood draws and things like that, but I've never really hit it on a regular basis. So this year I was gonna do it on a regular basis. So I go in April and I get a couple things done, and like the out-of-pocket cost was ridiculous. And they're like, well, you have a supplemental insurance. Because we had it down to like 500 or something, 600, it was lower. Maybe it was 900 for both of us. And we're thinking, yeah, kids are out of the house, finally. And they're like, no, you got a supplemental insurance. We don't know what the hell you got. So we screwed up, we don't know how. So in April, May, we're trying to get back into Kaiser. And Val gets back into Kaiser, she thinks she got me back into Kaiser, and, I don't know how it happened, but we got in June, I didn't get the bill or whatever, I got all caught up in August. I get it all paid, open the mail, and you've been discontinued. So now I am self-insured, literally. So until January first, so it's like, cannot have anything, nothing at all, I need to be a little bold. So hopefully nothing happens, or that would be one that's like, oh God, yes, convert everything C Corp. At that point, if I had something big happen, all right, any other questions? All right, let's talk about expenses real quick, home office, who has a home office? Wrong, who has a home office? No, you were right, the ones that didn't raise their hands are wrong, who has a home office? All of you have to have a home office.
Even though we have an office?
Well, you're an exception because you live at your office.
Okay, so we don't think that.
Here's the deal, I don't care if it's in the guest bedroom, it's a little desk and it's 2 by 4 feet. You have to have a home office. Here's why, you're self-employed. Okay, if you don't have a home office, that means when you leave and you go somewhere else, it's not deductible. When you have a home office and you leave, it's deductible. Okay, I have a home office and I have multiple locations I go to every day and it's all written off. Okay? Second thing, and it's not for the deduction of the home, that's peanuts, it's nothing, right? It is nothing. It is for your automobile expense. Now you get 2 ways. You can go actual miles or you go standard miles. In either case, you're required to keep a mileage log, business versus personal. Now, me personally, I have a business vehicle and I have a personal vehicle. I actually have 2 business vehicles and a personal vehicle. Got the convertible for the summer and the truck for the winter. And I just put the convertible in the garage and just detailed it and it's done. And so which is the better way? Oh, by the way, IRS does allow you to contemporaneously. Did I say that right? Contemporaneously, create a log. So if you're detailed in your calendar and your receipts, you can go back and create a log if you're ever audited for it. Okay, it's allowed. But for me, my truck's all business, my personal vehicle's all personal. Now, here's the deal. Do I use my personal vehicle for business? Yes. Do I use my business vehicle for personal? Yes, and it washes out. My business vehicle, 100%. So keep it easy. I do actual costs. Here's the rule of thumb. If you turn your vehicle over every 2 to 4 years, because you don't want that repair bill expense, you want to, the new car, turn it over and you're maintaining it, that's it, then go mileage.
Why?
Because you're gonna get a better deduction. So because you don't have as many repair expenses, you just have fuel and car washes and insurance, basically. And you're not having repair, you're gonna get, and I don't know the number today, but let's say it's 57 cents per mile. You're gonna get a better deduction that way than if you did actual expenses. If you are a person like me that drives your vehicle until it has 406,000 miles on it, on one, and the other has 187,000. And I just paid 2,800 for a repair bill, actual expenses are gonna be better off. So that's the rule of thumb. Now, here's the deal. However you start out, you gotta stay that way. And you're stuck with it, okay? So you just.
For the life of that car, not.
For the life of the car, thank you, that's where I got hung up. So if you trade that in, get into a new vehicle, you can change whatever methodology you're using, okay, at that point. But I found over the years that if you turn your vehicle over, fairly quickly, I'm gonna say 3, 4, 5 years. You're gonna be better off mileage than you will actual repair work. Now, there's some exceptions, like Jesus Christ, giving them miles and damn transmission went out, it wasn't covered under warranty. Okay, there are exceptions, okay, but for the most part, the rule of thumb is I get nickel and dimed a lot more on year 20 than I did in year 1, 2, 3, 4. Let's see what else, gifts. What is our limitation on gifts?
$25
Per person. Okay, unless we do what?
branded.
If you brand it, you're not limited. Okay, so gifts, as long as they're branded, without you can write those off and there's no issues. Sorry, I took up so much time on entities, I got caught up into it. It was good questions. What other expenses have you been talking about? Cell phone, I write my cell phone 100% off. I just did. Do I take personal calls? Yes. Do I do more business than I do personal? Yes. So I write that entirely off. I write the internet off at my house. Especially now that I have my kids there. Because I don't play games and I don't I don't even watch Netflix, but I am on the internet for work all the time. What else?
What are some like iffy deductibles?
I went, the automobile expense without a home office is iffy. You gotta have the home office and you gotta claim it. The gifts, people do. it all
Another
the
question.
time. Yeah, hang on one sec. They do it all the time where they write off more than $25 and technically they can't. Yeah, online, what you got? Is that Lee?
Yeah, I was gonna say, brokerage fees.
Yes, brokerage fees 100%. I don't think, now check with Elizabeth, but when we 1099 you, we do not 1099, we 1099 you after the split. So just so you're aware, but monthly fees, absolutely 100%. All your education fees, 100%. Your MLS dues, 100%.
Obviously, all your supplies.
Yeah, that's why I didn't really go into that as much, but yeah, all of those, yeah.
At the summit, I heard a couple of people talking about, a couple ladies talking about hairstyling and nails.
You know, it's interesting, that came up, recently as well, and there was. So here's what I'm gonna tell you. You can't write off this type of stuff, okay, but you can write off branded stuff. I have never told somebody that styling, getting a haircut or any of that's ever been deductible. And for the life of me, I don't remember, it was like a year or two ago, and they made a pretty logical argument as to how and why they were able to do it. I see that as a gray, dark gray, black area that's, you're not gonna win at the end.
More of a red color.
What's that? Red? Gotcha. But I am still not aware of hygienical type stuff being able to be written off. I'm just not aware, but I have heard people say that, yeah.
What about client meals? Client.
So business meals are still deductible. I know for a while there, I was actually preaching the other way, and it was a totally misunderstanding on my part. I did research it, and yes, as long as you have the 5 Ws, who, what, where, when, and how much. You got your 5 Ws, and 3 of those are on the receipt.
Oh, that was 50%.
Yeah, no, it is 50%, I'm sorry, it's not 100%, you still gotta do the entertainment deductible, which is 50%. You can't have tickets to the Rockies, you know, season tickets, things like that, you can't write off like you used to be able to do. You can do one-offs. But
So if I took a client to a game.
you can do one-offs, but you just can't write off in general that expense.
And obviously, any expenses for events that you have and supplies for open houses.
Yep,
food,
all that.
drink, all that.
Absolutely,
Client parties.
yep. Yes.
I have a random one. What if, like, so somebody said to me once, oh, you could go see your family down in Houston, go to a KW office and work a bit and write that off a plane ticket. That felt iffy to me. I was like.
Okay, so I'll go even one step further. Back when I was paying myself $10, the other big thing that we would do is we would have our shareholders meeting. In my life, shareholders meeting in Mexico, okay? And we would write off our trip. So here's how I'm gonna answer that question for you. How many hours how many hours do you work a week?
Right now, probably like 20 part-time in real estate.
Okay, how many hours do you work a week in real estate? Any of you?
How many hours in a week?
80, did I hear 80? Okay, great. That's usually the answer I'll get.
Okay.
Okay, I work 60, 80 hours a week. Great, fantastic. So how many hours on this vacation did you work? And we'll prorate it. That's the answer.
Okay.
So can you do that? Yes. Putting in 30 minutes or an hour at a KW office and working ain't gonna get you that trip.
Gotcha.
I don't even try right now. I used to.
Yeah.
I also used to take $10 a year.
But wait, so could people go to Bahamas?
Why the Bahamas? Where did that come from? You know, I actually, let me be clear. Let me be clear, I work from there, I'm on every Zoom meeting, I'm in every meeting via Zoom, I do not write, I do write part of it off, but it has nothing to do with work, it has to do with, work on a place as a revenue. And I don't write everything off, but I write some of the stuff off. Yeah.
Similar to that, I had seen someone here mention about like if you're traveling for referral connections.
I think, again, I think it's all about proration. So
Okay.
my answer to you is how many hours is your average work week? How many hours did you work on the trip? And you may find it out that it's negligible. On the other hand, you may go and you're damn serious. Like, hey, I write off family reunion, mega camp and the KW summit, I wrote all that off. 100%, right? So, did you guys stay for my dinner? You didn't, you guys left early.
I was there.
Oh, you were there, okay.
I was on the.
It was a good dinner.
Oh, it was
That
so
was a
good.
great dinner.
Yeah, it's made really good connection.
You don't wanna know what the bill was, but.
No, I
it was
don't.
good dinner.
Well, I turned around, I'm like, oh, I really know.
She handed me the bill and I was like, it includes gratuity already. Oh, God.
He did hustle.
She worked her ass off. She did. What else?
That
Any other
was
questions?
incentivized us to go to these things.
You know, honestly, I did. I don't think I've ever not, I think the only time I did was in Vegas, because we couldn't find a venue for 60 people.
Oh,
It was
right,
ridiculous.
yeah.
I could not find a venue that was gonna cost less than 10 grand.
Yeah.
But otherwise, I've always, even back, like, when we very first met, I took everybody to dinner. That's my thing, I take everybody to dinner. That wants to go to dinner.
Very appreciated.
You're welcome. What else? Any other questions? Like, I didn't spend as much time on the expenses, but I think. If you have questions on expenses later, whether or not you can write up, just call me. You know, if I don't answer, I'll return the call. So, alright,
Wait, I do have one on the charity, so you can write as
oh,
much as you want off on your business side, but not
Yeah.
your personal side?
you can't write anything off on your business side. So here's, okay, let me clarify.
Yeah.
Sub S, it's just gonna pass through, you're gonna get no deduction, just like before. And if you don't itemize, you're not gonna get a deduction. So if you don't itemize enough, that's why I double stack. So I get a benefit every other year. On the C Corp side. You can technically write it off, but why would you? You're limited to 10% of whatever your profit is, and if you're gonna have no profit, you can't write anything off. So it's ridiculous. Matter of fact, NOLs right now, carry forward on C Corps. Just ran into this. Now they're limiting you. And I don't remember what the year was. I think it's like 2018 or 2019, before and after. If it's before, you only get 75%. So I had somebody who's always had this loss. I'm like, oh, don't worry about it, we get the loss carry forward. Well, they got taxed. And I was like, damn. I go, my bad. I go, I'll pay the interest, I'm not paying, or I'll pay the penalty and interest, but I didn't pay the tax, the tax is on you. But yeah, they changed that one, and I'm so used to dealing with people that we don't have it. And they were relying on the NOL, now they can't rely on the NOL anymore, because you're limited to a certain percentage of the NOL. And they had like $20,000 NOL carry forward too, it sucked. So, learn something new every year. It wasn't a lot, it was like $200 or something, it wasn't a ton, you know, now if I was 19 years old, you know, I'm going, that sucks. All right, anything else?
Thank you.
You're welcome, absolutely, always,
Thank you.
I'm off to Evergreen.
Alright,
Thanks, Kevin.
You're welcome.
Yeah, she already did her, and I just called her last week. So she's from Sid, yeah, surgery today, eye surgery. So they might be able to want to figure out, I can get in the morning, with her, and so she was saying that, even if she comes like, and I get access, yeah. She just said she has